Watch out for Europe. Our next guest says if the process of resolving the debt crisis stalls, quote, markets could riot again. Mark Luschini is chief investment strategist at Janney Montgomery Scott, and he joins us from Pittsburgh. Mark, clearly no signs of rioting this week because we have 5 straight days of gains, even as some people describe it as a market that's grinding higher. This is a very headline-driven market, very touch and go. What could be the catalyst that sets things off once again?
Well, I think it's encouraging, of course, that we have some coalescing taking place among policymakers in Europe to try to put a fire ring around the Greek situation. But I think still at large is that, by all accounts, they haven't solved for anything yet. And so as a consequence, as we come closer and closer to Greece, for instance, running out of money and or towards year end, forcing a bond rollover and the need to pay interest on its debt, we need to see some policy initiatives actually supersize the European Financial Stability Facility or institute other measures that are going to help to, I think, create a more positive sentiment equity investors have about the fact the European situation won't express a more contagious-like situation, which could seep into much larger economic powers like Italy.
Right, and policy initiatives, not just policy emergency responses like the central bank intervention that we saw earlier this week. What kind of lessons did you learn from 2008, the last time we had a financial crisis that required everyone to jump in and hold hands and figure something out?
Well, in fact, you're starting to see a replay of some of those same efforts, such as the dollar support by central banks, including the Federal Reserve here in the United States, to ensure that European banks have the proper funding to continue to offer loans to their American counterparts. And also some money market funds beginning to pull back from some of their exposure to European banks. So one of the things learned is don't allow this situation to fester until it becomes more untoward, both in terms of observing the path that we're on currently and not seeing resolution, in order to make sure your equity portfolios are positioned to account for perhaps what could be this so-called rally turning into something that has a longer runway, and or to also brace against a potential market riot in the event we don't see a more hard and fast solution brought forth.
All right. At the same time, you have the specter of recession here in the U.S. You say that equity valuations are appealing. Beyond defensive names, dividend payers, where in the cyclical space would you consider buying?
Well, 2 areas look appealing to us. One is energy. We think the long-term prospects for energy prices to remain at elevated levels is quite high, given the fact that about 50% of the consumption of oil is occurring in emerging markets, which are still growing at a very handsome pace. The other is technology. Valuations in that space are exceedingly attractive. And, of course, we know that business investment and spending on software and hardware has been the one bright spot in terms of economic activity over the last couple of quarters, even as GDP has gotten lower sequentially. So we like both of those areas as pro-growth cyclical plays to barbell that of more defensive names in the healthcare and consumer staples space.
All right. Thank you so much, Mark Luschini, favoring the cyclicals of energy and technology. We appreciate it.
Thanks, Scarlet.